Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, May 1st, 2024, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by Viper XL 007, and we had a little bit of some technical snafus getting rolling here. So we don't have our fancy graphics with our nice introduction here, but we are going to have a relatively brief episode because, well, we got a late start, and we're going to touch on inflation because the Fed had its meeting conclusion today and wrap up. And then we're also going to touch on a little bit of the Bitcoin halving that we talked about a few weeks ago to see, hey, how's that tracking of the historical fourth halving event? But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 where I post each and every one of my equity trades, the good, the bad, and the ugly. Lastly, you can pick this up wherever you get your podcasts, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, inflation. This is a topic that has been front and center for the better part of, 2+ years now? Talking about how inflation is on its rise to historic highs, and then are we in a pullback on inflation, and where are the Fed rates going to be? And it's just been a topic we've touched on here or there, and it's really been starting to kind of, interest me a little bit more and more about, what's going on with inflation and the Fed rates, and is it really such a big deal as they make it out to be in the mainstream media? And I thought we might just touch on the topic a little bit to maybe just share some rough thoughts that I have, maybe that you have as well, because Chairman Powell got up there today for the Federal Reserve meeting and kind of basically said, well, yeah, we're definitely not cutting rates anytime soon, and we've raised the bar on even hiking rates. And so basically he kind of is implying that we're going to be at this rate level for longer than everybody had anticipated. And the market really rallied hard at first on this news that they had raised the bar for kind of rate hikes, meaning that he didn't really see a rate hike coming, and everybody, I guess, got excited on that commentary. And then the market, in its true bipolar fashion, just completely dumped a little bit later. So it was one of the widest variations intraday that we've had in, I think they said since 2021. I don't know. It's been a while. But there was just massive, violent downtrend all day leading up to Powell talking. We just massive rocket shipped up, and then a little while later start kind of cooling down.
Almost like these news events that maybe news is noise, would you say?
There's today is a big case for it, because I bet you if you looked at the chart, you probably could pluck out a couple of the levels there that price action probably ping pong between, and it probably validates or kind of backs up our whole news is merely an accelerant to the price action.
Always, at least, I mean, I haven't looked at this specific price action chart, but I mean, anybody that's watched for a while and anybody that watches in the future will certainly see time and time again that I have yet to find a situation where it was, whoa, that was unexpected. And yeah, I would agree that there is most likely two very firm levels where it bounced between, and I would also venture to say the overall trend that it's on was unchanged as well. But that's how it goes. And I guess we harp on it. At least I harp on it just because it's, I don't know, it's been one of the more, not to completely tangent here, but it's been one of the more empowering things to grasp. It's also been one of the more complicated, maybe not complicated, but complex things to grasp as well. But as I continue to get a better grasp of it, it's been more empowering because, I still remember, and I'm still a victim to it from time to time, that you see giant green candle or giant red candle and it's just panic of like, oh, what's happening? But slowly, very slowly, over time, less and less of that panic and more of validation, which haven't pivoted to turning that into fully profitable, but I can see the potential for harnessing that power for good.
Yeah, no doubt. And, that's kind of, always intrigues me. And we'll give that as homework to our viewers to go out and chart the S&P today on May 1st and see where those levels went to in that massive volatility swings. But what's kind of got me thinking is all this inflation talk. And what I mean by that is, there's a lot of people saying, oh my gosh, we can't sustain this level of inflation, or sorry, this level of interest rates. Inflation's going to roar itself back. We got to cut interest rates to keep things down before, we basically stall the economy and go into a recession, this, that, and the other thing, focusing around those federal rates, Federal Reserve rates. And that really got me thinking because, it's one thing that Viper and I really call out on this show is, know your history. Because history doesn't ever really repeat itself, but it often rhymes. And so pretty much in every different situation that you can find yourself in today, you'll never find the exact situation in the past, but you'll find situations that are very similar. And so that really got me digging around different economic data and stuff because I always read about this time in the 1980s when inflation was in the double digits and interest rates were up there in the double digits. Paul Volcker, the Federal Reserve, basically massively hiked interest rates to basically try to squash inflation that was just running out of control to the late 70s, early 80s. And the rates were crazy high. I think my parents probably ended up in a double-digit mortgage in their first home, who was, probably 12, 15% mortgage rate back then. And I just think about that and I contrast it with the stuff I read in the mainstream media where all these people can't get their homes because mortgage rates have crossed 6% and it's just, the craziness and how are they ever going to attain, wealth building and stuff like that. And when the price of home ownership is so high out of their reach because the rates are at 6%. I think they're up at 7%, but my first home, which, I bought back in the early 2000s, my very first mortgage rate was 6.25%. And so that just really got me thinking, like, where do I go get some of this data? Where do I go look at some of this stuff? So yeah, we had pulled this up when we were kind of digging through some stuff in past episodes. It was put out by the St. Louis Fed. I encourage you to go there. I'll put a link in the show notes below where you can get in there. But I started to pull up what is the median house price in the United States. And they had data, I think it goes back to 1960, something like that, up to today. And it just kind of plots it. Now, what's there is the actual raw number. So it's not adjusted for inflation or anything like that. So it just gives you the chart that says, hey, this is the price of the home on this particular year, the median sale price. So it's not, what were the houses listed at, it's what was the actual transaction. And notice right there, the chart is up and to the right. So this is a great site to kind of pull up this historical trend in home prices. And, this site doesn't just have home prices, it also has salary. So, we can click over there and we can look at the median salary of over time. Now, I don't think the salary quite goes back as far as the housing did because I wanted to get a nice apples to apples overlay there. Much like the housing one, this again is not adjusted for inflation. And so I started kind of deciding, okay, what can I do with some of this? And so the Federal Reserve and the government actually puts out a calculator. There's all kinds of calculators on the internet. If you Google for this, I wanted to make sure I stuck with something that was, in the same vein of the people there that are putting a lot of this data together. And so there's this CPI inflation calculator. I'll link to this too. And what this allows you to do is put in a number and say, this is in what year, what month. So Viper, go ahead and put in there $81,000 in 1984. And that $81,000, if you were to look at the housing chart in 1984, that was the median home sale price in 1984. So if we take that and we bump it up to 2023 and we calculate it, it will tell you, hey, in 1984, those would be worth this particular buying power in the current time. So if you run that calculator there, I think it'll come out to maybe $237,000. I think that's the wrong year.
There we go.
Yep, that's the one. So if you look at that, so in 2003, that $81,000 in 1984 would have had a purchasing power of approximately $237,809 in 2023 dollars. So what that tells you is if home prices were just rising up from inflation, the median home price in 2023 should have been about $237,000. However, if you actually look at the chart, the median home price in 2023, I believe, was around $430,000. And so you can kind of put that in there, and we can do the same thing with the household income, median household income. And so I think in 1984 income, something like $56,000 or $57,000 in 1984 would have translated into roughly about $166,000 in 2023 dollars. So if all things equal, wages kept pace with inflation, that should be the median household wage. But if you actually look at the economic data, you can see that the median household wage in 2023 is probably around $75,000. I think that might only go to 2022, which was $75,000. But you can see right there, okay, that means that wages are not keeping up with inflation, and housing is actually outpacing inflation. And so if you want to try to normalize that and throw all that aside, right, you can just take the median home price, the median salary divided by the median home price, in 1984, do the same thing in today's dollars, and it'll kind of normalize that stuff out. And you'll start to see that there actually might be a little bit to this story, that there is probably a widening of this wealth gap. And this widening is going to be the difference between what I would call asset holders and those people without assets. And I would speculate that if we went back to 1984, the same phenomenon would have been exhibiting if we rolled back, 40 years before 1984, and we looked at, 1944. And I think this is just my thoughts here, really speaks to the investment and wealth building power of things that are like assets. So your home, like you should buy a home because it's going to appreciate over time. And that's the type of thing that helps you build wealth and stuff like that. And I bring that up ironically because we talked about that new Homium product, right? Where you can take a percentage of your home and get that loan out. And this is exactly why I thought during that episode was like, hey, I would like to be on the other end of that and lend that out. Because historically speaking, the price of homes and those assets appreciate, and they appreciate above the inflation rate. So I threw a lot of things out there, just saying that, trying to keep things into perspective. And I really want to dig more around this. I want to, look at more things like groceries, and different aspects of that. But there really might be a little bit to some of the media panic about this wealth gap. Now, I don't know that necessarily means that we're going to have a massive recession, right? Because you got a bunch of people that have the assets and the wealth that are kind of propping up the market and propping up the economy. but it probably is a signal that there is a growing divide between the higher income individuals that actually have assets and stuff in their ownership, and those that are kind of new to the world and are trying to acquire that limited number of assets.
It's definitely interesting, and there's something I would point out which nobody should listen to as me knowing what I'm talking about, but more as a jumping off point of very interesting data to look into. And that is, I had recently heard some stories from some residents in Australia, down under, and talking about their housing market. And their housing market is kind of, I mean, in some ways, it feels like where, I don't want to say where we're headed, but like we get like what we just talked about with the median home price and the average income and stuff like that. It has a flavor of, you know, what could be the beginning of where Australia finds themselves. And as I understand it, and again, this is off the top of my head, it was just something that I thought of when we were talking about this. So by all means, if this sounds interesting to you, go find official data and dig into it officially. But I believe in Australia, the average home price is somewhere on the order of $1 million. And it is a significant problem for young adults to be able to purchase a home. And that was, whether it was any economics of inflation or anything like that, but there was a period of time where people were encouraged to buy houses, and now they're being encouraged to buy houses as that retirement asset. And you can rent it out and just get a bunch of friends together and you'll all split this house and all this. And so it's interesting. The thing that made me think of that was the gap of median home price and median annual income. And that made me think of that situation because that feels like, kind of what this could potentially lead to, of just crazy high priced homes that are way out of price from average annual incomes. But not saying, because again, if anything we talk about here is not financial advice, we're certainly not economic advisors as well. But these are things that just kind of random thoughts of, maybe that strikes something. I'm going to go look a little bit more into it and see what kind of correlation there is, or what led to those Australian home prices being so high. But in general, very interesting to see the data, to see those gaps, and to dig a little bit deeper, because obviously anybody anywhere that listens to, not even a particular mainstream news source versus whatever, like inflation is permeated the psyche of daily conversation. So it's certainly interesting to dig in and see the data directly and correlate these things.
Yeah, and that's really why I wanted to bring it up and just chat about it just briefly on this show here, is because you get fed a lot of conclusions by mainstream media, by people's posts on X or Facebook or whatever social media, Instagram you follow, and just remember that that's someone else's conclusions, and they got that from somewhere, and sometimes that source of information, who knows what it was. And so I wanted to bring this up because there's a lot of public information out there that's factual, from census data, from actual, raw hard facts, that doesn't have any tilt or spin on it. And it's go seek that out when you hear these things, and lift the hood to figure out what's going on under here. Does this make sense? Let me check it with my own logic and my own thinky brain. And that's why I wanted to pull this up, just to remind viewers that this stuff is out there. And with all this talk, it's really got me interested. And that's when I started digging. And I'm still going to dig a little bit more, because usually with everything you hear everywhere, there's always nuggets of truth to it. Now, how big those nuggets are and where they fall, right, that's the magic you have to kind of figure out for yourself. But that's where I want to look into this, because I'm very curious, how different is today and this time versus times in the past when, the economy was potentially contracting from high interest rates, so high inflation rates, where we raised interest rates really high to quash the inflation, and what happened to the economy. What was the side effects? How did people fare? Because, like I said, history doesn't repeat itself, but it often rhymes. And so, drawing parallels and looking back in history gives some indication of the probability of some of similar events and stuff occurring here. Nothing is ever definitive, but the more you know, the more educated you can make some of your probabilistic views. All right, Viper. So enough with this inflation and interest rate talk. A couple weeks ago, maybe 2 weeks ago, 3 weeks ago, Bitcoin went through the halving, or the halving, where the value of Bitcoin mined got cut in half. And we had a couple of theories on different price charts of that, and we're not that far past it, but talk me through. Have you been keeping an eye on things from that? I think it was a rainbow chart that we had showed.
I'm keeping an eye on it. I don't know what else I keep eyes on these days. But yeah, so let's take a look. Let's just jump straight into that rainbow chart that you mentioned here. So reminder, a little quick refresher on what we're looking at. This is the entire price history of Bitcoin on a logarithmic scale. So that is kind of why it has this arc to it. And that's so you can. It's an interesting scale to use when you're trying to cover a large period of time on a particular chart, because you can grab the price range, from $0 all the way to $70,000. But what I thought was interesting is this chart in particular, we're using the logarithmic regression, which is the rainbow portion of that. And I'm not going to try to recap what I've very loosely learned about the logarithmic regression chart. It is very interesting stuff, and I did read up on it. But I know that it's a very interesting way to look at specifically cryptocurrency. And I mean, we kind of talk about this with trading bots and pricing levels and all that stuff, algorithms that run the financial world, and things like cryptocurrencies really adhere to these things, these rules of Fibonacci sequence and things like that. So that's all part of what shapes this logarithmic regression here. But more importantly, to the point, I charted on here each of the halvings that we've had so far, like Sprocket mentioned, where the rewards for mining a block of Bitcoin get cut in half. This is programmed from day naught, as they say. So this is not something that Jerome Powell pedals out and says we're gonna have it today. This is programmatically predetermined since the beginning of the blockchain all the way to the end. What has happened, and something that I called out before the halving last time, was the whole history doesn't repeat itself, but it often rhymes. And so one of the big narratives in the crypto space is these blue lines I put on all-time highs. And we always, we would hit on all-time high, we would pull back, and then we'd march forward, we'd get halved, and then we would sprint to new all-time highs. And so we'd have these bull markets, bear markets, cycles. And in general, that's been the narrative in the crypto space, is a halving is coming, which means a bull market will quickly follow soon after. Now, that is not intended to be financial advice or a prediction of what's to come, because I did call out, if we zoom in here, one of the interesting things that has never happened before on the rainbow chart is Bitcoin hit a new all-time high here just several weeks before the halving. And so that is something we have not had before. So the whole rhyming thing and not repeating itself. And so that is to say, we don't know exactly what's happening. I mean, the logic is there, and we unpacked this last time. The logic is there, the mechanics are there, that a bull run will follow at some point. And that is, these rewards getting cut in half, like I mentioned before. the power, the electricity usage consumption cost to mine one block of Bitcoin, or one Bitcoin itself, was about $40,000 pre-halving. So post-halving, that electricity, the cost of mining that one Bitcoin has doubled, and so now it's around $80,000 to produce one Bitcoin, and that alone is a significant impact and factor on the price of the underlying token, as you can imagine, because the people producing it don't want to produce it and then sell it at a loss, so they will not sell it, and there goes your sell pressure and yada yada yada. They're interesting economic thoughts to follow there. So here's where we're at. We are a dumping. So we had the halving here, and we are down. Let's see, what are we down total from that all-time high we just had? We're down a solid 20%, and just steaming along. Honestly, I'm pretty excited about that. It was I mean, you can see it in this chart here. This is, I feel like when we talked about this in other episodes, of multiple episodes of buy the rumor, sell the news, and all that kind of stuff. And with Bitcoin, we had the spot ETF, which was a massive buy the rumor, sell the news event. And so I don't want to get into too many hypotheses about that, but suffice it to say that I certainly could see the argument for this little bull run recovery here leading to all-time highs. There were a couple, I didn't mark it on this chart, but it was actually I believe in this cluster just below $50,000. This is where the spot ETFs were approved. So we kind of had these two news events, and people buying those rumors of the spot ETF, which absolutely could lead to the buying pressure, the speculative buying pressure leading up to that spot ETF approval. And then right after that happened, we have the halving coming up. And so there's again a wave of that speculative buying of, the halving is coming up. It's going to pump after that. And I'm going to buy. And people selling of like, hey, the halving happened. And guess what? Life is the same. So that's a gross oversimplification, but nonetheless, I am still excited. I'm still glad to see a pullback well underway here. And if we take a look at the chart, I mean, like on the daily level here, like it just makes sense. This was a very strong run up to all-time highs, teetered out, and now we're pulling back, as you can see here. So real quick, some PA on the fly, and some of this isn't entirely on the fly. We did have some discussions in Discord today about where are we headed, what is the pullback most likely to lead to. So to summarize that, because there was a little bit of, I don't want to say disagreement, but I saw it a little differently from one of the other traders in the Discord where, and I just want to unpack this real quick. My thought was, if I get my box out here, I particularly had eyes on, let's see, 55-ish. Let me throw this roughly in here. I kind of had eyes on this range here as to where we might pull back to. And this was a critical range that I derived from the weekly, and maybe it was on the daily. But nonetheless, this was a range that I had of like this roughly 55,000 to 57,000. It's a chart. It's a range that I've had on my chart for a long time, since long before price got here. And you can see we just blew straight through it, and we kind of wicked down to test the top of it here. So I'm still partially in camp that this could be a reasonable pullback, but I am also being convinced that this isn't really a strong enough level, because one thing, and this is where we kind of get into more of the nuances of price action, the reason I had charted this range is roughly this cluster of candles, and I'm being opaque and vague because I don't want to get too lost in the weeds here, but I could show where exactly I anchored that to, and it's based on this big sell-off candle here, this loss, that happened. But what I wanted to call out was when you have the cluster of candles that you think is an important level, and it very well might be an important level, but if I'm playing devil's advocate, like, well, what's the difference between this cluster of candles on the daily and this cluster of candles? And so luckily we have a way to resolve that, and that is zoom out, go to a higher level. And this applies to any chart you're trying to read on any time frame. The lower the time frame, the more noise you get on the chart. And so if it's too noisy, back it up and go back out. So if we go from the daily here to the weekly, we can actually start to see that what looked like it might have been a decent range on the daily, all of a sudden there's not a ton of leg to stand on here on the weekly. If we extend this further back, there's a case to be made of this former all-time high, now 2 all-time highs ago. But that's kind of getting a little too historic. We want to always anchor to most recent events, most recent failures, most recent gains, all that kind of stuff. So when we finally go back, because so now there's not really much of an argument for my daily range here. And then finally, if we go back to the monthly, this is where I'm becoming a little bit more sold on where we had our discussion in Discord. And this is a good example of how clean the chart can get when you have too much noise zoomed in. This is a lot cleaner. You clearly have up, and then we pulled back, but we pulled back and then put in a new all-time high, and we pulled back again. We tested the swing that led to the all-time high, and it started to hold, and then it failed. And so this cluster here is really important. And so that is the cluster where the other trader in the Discord has anchored his chart. And I'm starting to understand why and see it, because like I said, when you take that noise out of the chart, it actually becomes a little more understandable as to some of those core mechanics of it. So that is to say, who knows where it's going, but there is a probabilistic case to be made that we could be pulling back here to 44,000 to 48,000, this range here, because again, like I mentioned on the other chart, we blew through it. All ignoring all things, just looking at this chart, this is absolutely a critical range based on these candles. And on the way up, we smoked right through it. And in the world of price action, when you blow through a range and you don't stall out and kind of do a little stair step, gain and test and get support, you increase your probabilities that you're going to come back to that range and test it out. So at least as the monthly chart goes, this certainly has a good probability here. So while it is not anything I'm basing any financial decisions on, because trading a monthly chart is pretty brutal. Those candles are huge. But it does all line up with the various theories and theses about, pre the next bull run, per se, is having a steep pullback. That steep pullback, I mean, it works in a lot of ways. It works on that monthly chart. It works on this logarithmic regression chart, because you can see this blue range here, which is the midpoint of the logarithmic regression. Conveniently enough, as this line extends over time, that's around $48,000. So there's a case to be made that we'll pull back there, give that a test, maybe hang out there, maybe go a little sideways before we get, the rest of our leg up for those miners now making Bitcoin for $80,000. So I don't know. If none of that makes any sense, let us know. Maybe we should do more price action videos and better explain it. I know I kind of rushed through a lot of that and still took a lot of time, but that's what I'm watching. That's what I'm interested in.
Yeah, definitely, Viper. Appreciate that. It's definitely interesting. We'll keep an eye on that I think you will. I don't keep my eye too much on it. I'm just kind of waiting for my AVAX to kind of appreciate a little bit, and we'll see where that goes from there. But that's why I keep you around, so you can let me know what's going on in crypto land and if I should pay attention to something. But other than that, that is the end of this week's episode. Like I said, hopefully, if you get all this news and stuff you hear about inflation and interest rates and the economy and this, that, and the other, don't forget that there are objective sources of data out there where you can go and draw your own conclusions and do your own research. The St. Louis Fed is one that, we'll link below. Definitely where you can get all kinds of historical metrics and stuff like that has been recorded in an objective way. Draw your own conclusions. You can have a theory. You can pan it out. You can test it out and understand what's behind it all. Don't just take someone else's word for it. Don't take my word for it. Don't take Viper's word for it. Don't take Jerome Powell's word for it. Go see for yourself and learn and educate yourself to be more holistically round when it comes to that stuff. Also, Bitcoin and crypto and the halving and price action, every time we cover a story, cover an event, things like that, it's always funny how much price action is really lingering there in the background. And whether or not it's a earnings announcement or a Federal Reserve interest rate announcement or a halving event in cryptocurrency, all of these things can be accelerators to an already existing price action. Whether or not there's some magic there in the price action or that's everybody believes in price action, so therefore it is true, go form your own conclusions. But it legitimately is a thing that traders can trade against and with great probability do pretty well to follow it. So hopefully you found something interesting here. Otherwise, get a hold of us in the Discord. Let us know what you want to hear about and what type of content you want us to hear. Otherwise, good luck out there, have fun, and remember, think outside the block.